Hey Bowtie Nation, Joseph Hogue with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. Nation, one group of stocks is emerging to define 2026. It's not AI, it's not robotics. This group of stocks will not only grow your portfolio, but will also do well when the market falls and protect your money. I'm going to show you the top 5 stocks to buy right now in that group. I'll also share important updates to shares of ServiceNow, ticker NOW, SoFi Technologies, SOFI, Shopify, and an update to our stock market outlook. But first, onto those stocks to buy because, folks, one theme is developing that is going to define not just 2026, but the next 3 years: war and how we're going to fight it. First, we had Venezuela, the slow buildup of firepower in the Caribbean, exploding with Operation Absolute Resolve, a force of 150 aircraft, ships, and an interdiction force to capture Maduro. Then came Greenland, with the US only stopping short of taking the island by force at the last minute, and later negotiating for a scale up to US involvement as part of a Golden Dome strategy. And inside reporting now reveals that the administration is actively planning regime change in Cuba by the end of the year. Cuba's economy is near collapse from lack of subsidized Venezuelan oil, and the US is looking for officials in the government to topple the regime. Through all this, President Trump has talked up his dream military with a $1.5 trillion budget, surging military spending by 66%, making it by far the biggest part of federal outlays and of any country. Stocks in the Global X Defense Tech ETF, the ticker SHLD, plunged after President Trump said he wouldn't use force to take Greenland. But is there any doubt that this is the one group of stocks that is going higher for the next 3 years? This is something I talked about in our Friday's video, but I want to go deeper here because these are the stocks to buy no matter what happens to the rest of the market. The stocks that are not only going to grow your portfolio, but is also going to protect it from a crash. Looking for the stocks to buy in this theme, we can start with the companies that were involved in the president's Golden Dome project before it was sidelined on budget constraints. The program consists of multiple layers of sensors and surface-to-air systems to shoot down incoming missiles. It starts with a space-based intercept layer of tracking satellites that is backed up by 3 land-based systems, including the Patriot Missile Defense System, hypersonic weapons, and cruise missiles. Palantir, ticker PLTR, had emerged as a frontrunner to build key components of the system, with the company booking 52% revenue growth from government contracts to $486 million in the most recent quarter alone. We also find the biggest names in missile defense and contractors, including L3 Harris Technologies, ticker LHX, Lockheed Martin, LMT, and the old Raytheon, RTX. L3 may have the best hand here with its $150 million new facility in Fort Wayne to build those hypersonic and ballistic tracking space sensor satellites. Not only is the facility tailor-made for that Golden Dome project, but spending on the new facility caught Trump's eye when it was announced last year. I've been recommending RTX as the top maker of missile defense systems since mid-June when those Iran nuclear sites were targeted, and the shares are now up 35% since then. RTX has a strong lead in interceptors for this new era of warfare and is building sensors to compete with their other contractors. We can also mine that Global X Defense Tech ETF, the SHLD, for ideas here, or just invest in the fund for exposure to 49 companies in this theme. The fund reaches stocks across cybersecurity, data intelligence, military systems, and large defense contractors. It shows here global defense spending is already increasing at a solid 9% per year pace to over $2.7 trillion in 2024. And if President Trump gets his dream military, that number will balloon higher. Within the top 10 holdings, you find the heavyweights like Lockheed Martin, ticker LMT, RTX, Palantir, L3 Harris, and Northrop Grumman, ticker NOC. Lockheed is the largest U.S. defense contractor and supplies the F-35 Lightning, a cornerstone of the U.S. and allied air power. L3 Harris is key to that Golden Dome program with its integrated communications, avionics, and missile tech platform that ties those sensors to the shooters. We also see smaller players here like Kratos Defense, ticker KTOS, specializing in unmanned systems like the XQ Valkyrie wingman drone supporting the Pentagon's push to those autonomous swarming drones, and AeroVironment, ticker AVAV, the dominant player in unmanned aircraft systems with its Puma Recon drones. Here in a price chart over the last year, we see with strong returns from some of the smaller defense tech names, the SHLD fund itself has done really well, posting an 89% return over that year. That is well below the 223% return on shares of Kratos, but has outperformed some of those larger names. So this actually might be one of the cases where you just get exposure to the entire theme with just that one ETF, an ETF that is going to outperform some of the larger names by virtue of all those smaller names growing faster. I'm going to show you the stocks I'm watching this week next, but if you haven't already, join me on the Blossom Investing app, linked in the description below, to see all the stocks in my portfolio. You're going to get real-time updates to the stocks I'm buying, plus see what over 500,000 investors are talking about in the social feed. It is totally free to join up and help support this channel, so look for that invite link below or scan the QR code here. Looking at the stocks I'm watching this week, it is going to be another big week for earnings, with ServiceNow, ticker NOW, reporting its earnings on Wednesday, with the shares down 41% over the past year and in good value territory for one of the best software stocks. Investors have been worried that AI is going to eat into software growth as people vibe code instead of hiring these companies like ServiceNow and Salesforce. But that full transition is going to take years or more at best. Until then, ServiceNow has an upside opportunity to be the intermediary with its AI agents, helping customers use AI in their operations. Revenue is still expected to grow at a strong 20% plus pace this year and next, which doesn't sound to me like an industry in trouble, and with earnings expected up even higher at 25% pace this year. Now, if the company does hit that current year revenue forecast, it's going to mean the shares are priced at just 10.2 times on a price to sales basis, less than half of where they've traded at in the past. Now, yes, AI may eventually transform those software companies, but ServiceNow is going to have a few upside surprises before that happens. All you out there in the nation are going to be watching SoFi Technologies, ticker SOFI, which is also reporting its earnings this week on Friday. This is one of the strongest performers in my portfolio, up 344% since I started recommending it, though I have started taking profits since late November as the stock gets stuck in this $26 to $30 a share range. Now, management is still doing a great job, expected to grow revenue by 36% this year to $3.5 billion, and member growth continues to boom, but investors are just paying too much for that growth. The shares here trade for a price of 3.7 times book value, compared to an average of just 1.3 times price to book valuation for all the bank stocks in the KBE Bank Index. That is a 180% premium, which means that risk of a sell-off is very high if investors hear anything they don't like. And besides those valuation worries, we have started to see bank stocks mostly fail to impress investors with their earnings, with the financial sector ETF, the XLF, down 3% this year, much of that since those earnings started coming out 2 weeks ago. I still do like SoFi as a very long-term fintech leader, but the easy money is made here, and I'd rather find less expensive growth stocks until this one gives me a better price. And Shopify, ticker SHOP, is down 18% in the last month on that slide in software stocks, but also has rumors of cuts in its partnership division. The company is a cloud-based e-commerce platform enabling businesses of all sizes to sell online and is the dominant player with a 26% market share. It's well above any other competitor. That market share is a hint at the company's competitive advantage, a unified platform where a business can do everything it needs, plus the largest e-commerce developer ecosystem around. There is still a massive opportunity here, with just 11 to 16% of retail sales online globally, and with Shopify the key player, it's set to take the lion's share of that future growth. This is a company growing sales by 30% a year, so you'd expect a pricey stock. Now, on this year's expected revenue of $11.5 billion, shares do trade for a price of 15.6 times that sales, which is cheaper than where it's traded at in the past, not the lows that we've seen, like around 14x multiple last year. I do like the stock here at $137 a share, but would gradually build into a position, hoping for more dips, and would be all in if it fell further to around $123 per share. Giving you that bigger picture here with the Sector Spider sector tracker, 4 of the 11 stock sectors closed higher last week, with stocks in the energy and material sector clearly benefiting from a huge drop in the value of the dollar. The DXY dollar index, the value of the dollar against a basket of other currencies, fell almost 2% last week, a drop we've only seen 4 times over the last 5 years. The falling dollar versus other currencies that boosts the value of oil and other commodities, which is why energy stocks and the miners in that material sector did so well. And that crush in the value of the dollar came as the result of selling by foreign investors in the treasury market. Foreign investors own over $10 trillion in US debt, but are gradually selling out and shifting to gold as a reserve asset. Nation, it is rare for foreign governments or funds to publicize this selling as they don't want to crash the treasury markets and lower the value of what treasuries they have left. But we heard from multiple funds last week, first from Denmark and then a Swedish pension fund that have started selling their treasury holdings. The trend you want to be watching for here is that ongoing selling could hit the price of the 10-year treasury, pushing its interest rate higher even against those Fed rate cuts. That would be a problem not only for the economy, as those higher interest rates hurt borrowers and the housing market, but would also weigh on yield sensitive sectors like financials, real estate, and utilities. That means we need to keep an eye on the 10-year treasury rate, and if it doesn't come back down over the next month, it could be a warning for the market and especially stocks in those three sectors. Updating our stock market outlook, Chair Powell and the Fed are expected to keep interest rates on hold when the FOMC meets Wednesday. This CME FedWatch rate tool, which uses futures pricing to estimate market expectations, so what the market expects interest rates to do, shows a 97% consensus that the Fed will keep rates steady. Still, high inflation pressures and a fairly stable economic growth have pushed back odds of rate cuts this year to just one in June and then one more in December. Now, normally, a Fed stuck on hold would be a distraction for stocks and probably worry investors, but two reasons could make it less of an issue right now. First, President Trump has vowed to replace Powell with a low rate friendly chair when his term is up in May. More importantly, though, with the foreign investors selling treasury bonds and forcing those long term interest rates higher, seems the Fed's power over the short term rates doesn't matter quite as much. We will see more inflation data on Friday with a delayed December reading of the Producer Price Index, that PPI measure of inflation, but it's also likely to be written off as outdated. Inflation is hanging close to 3% annual pace. That's well above the Fed's target 2% pace, which again also means fewer rate cuts in the future. Now, that might be more important to investors in a month from now, but right now, the only thing the market cares about is earnings, and these are looking very supportive of stocks. Analysts see final fourth quarter profits coming in at 8.2% for companies in the S&P 500 index, and with companies generally beating expectations by around 5%. That puts actual earnings growth well into the double digits. And here, even the fact that earnings growth is expected in the low single digits or negative in 7 of the 11 stock sectors doesn't seem to be worrying, as analysts expect profits to come roaring back this year to a 15% average for the index, and for all 11 sectors to post positive growth in 2026. That means while news-related dips are always a risk, and we're sure to see at least a 1-5% correction sometime during the year, a strong earnings growth should keep stocks in an overall upward trend. Taking earnings growth and valuation into account, analysts expect stocks in the tech sector to outperform with a 27% return this year, followed by consumer discretionary, 15% higher, utilities with a 15% return, and real estate with a 14.5% return over the year. As I pointed out on Friday, I still like the healthcare stocks despite expectations for just 11% return this year on its role as a safety play in the market stress, and think the consumer staples sector could do much better than this 7.9% as those valuations come into play. Join me on the Blossom Investing app and see the stocks I'm buying now. Join over 500,000 investors in the social feed, free to download with the special invite link in the description below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.